We've got bond yields that are higher. Stocks did fall yesterday after the Kevin Warsh press conference, but now they are kind of not doing much here this morning. And as I listened to Kevin Warsh yesterday, I had a couple of thoughts, and the market seemed to have these thoughts too. If you're going to talk tough, if you're going to make the choice to talk tough and say price stability once every 5 seconds, you're going to have to back it up. And that was a choice to say price stability all the time. He didn't have to do that. And the other thing is, you can say all you want that you want the market to not take cues from the Fed, to take cues from the data, but the market's going to take cues from the Fed, no matter what you say, because they're going to extrapolate, oh, this data point, what's the Fed going to do? I mean, Barb, I don't know. It felt like a little bit of a flub yesterday.
Well, I think that's what the market reaction and a lot of commentators are telling us this morning, because he really, he is saying that he is going to not do any forecasting, but he really gave no indication of how they think about things. If you look going into that, there's always a bet on what is the Fed going to do? Are they going to hike? Are they not going to hike? And usually by the time you get to a Fed meeting, it's 95%, it's going to hike or not. Yesterday was very unusual in that it was like 35%, going into that, meaning they didn't know because, you look at what's happening, inflation is stuck. He keeps talking, we're going to get it to 2% target, but does that mean a hike? I didn't think there would be. The recent and certainly the PCE number this morning was in line. It was okay. The inflation number last month was okay. And I think, he's given enough indications that, the oil pricing, even though we've still got a flare up in the Iranian situation, may be transient. So, he is being data dependent. He's not saying that, but I think people are disappointed that there wasn't some sense that are we going to hike or not hike? And how's he going to do this? So, I think it's probably a bit of an overreaction just because he's a new Fed and we don't know what he's thinking. And he also has all these task force, and that may be what he's waiting to. One of them is productivity, which, he's factoring in. How much is that going to tamp down inflation? Another is what inflation data do we look at?
Right.
So, but yeah, there's a big disappointment because as you mentioned, the 30-year right now is at record highs. We haven't seen that in many, many years.
Yeah.
So that's a bit concerning because that can, cascade down the, down the yield curve.
Right, exactly. I think a 19-year high is what we're seeing for the 30-year this morning. We also, by the way, got GDP this morning with the second quarter, 1.5%. So it came in worse than the earlier read and worse than economists were estimating. And so the other thing that I find interesting is that Warsh seems to be also saying, like, I'm watching the markets. I don't want the markets to watch me. But I don't know if we want a Fed that is making decisions based on the markets. Yeah,
I think his message was a little bit murky in that regard because then the market is saying, all right, we're going to tell you what we think here, and we want more, more guidance. So that is going to be a problem, adjusting to his communication style or lack of communication. But you're going to certainly hear from other Fed, people this next few weeks who could provide some clarity, on the thinking behind that. But it'll be interesting. Sounds like, it could be an adjustment, or he may adjust his own style when he sees the market reaction.
Yes, we'll see if that's what ends up happening. I mean, what are the implications as whether the Fed is raising rates or not, rates are going higher right now.
Right.
So, what then are the sort of implications of that?
Well, if rates are going higher, it's really an anticipation of higher inflation, which means then hopefully there will be a reaction, in the Fed in terms of, of rate hikes. I think people are a little bit concerned because Kevin Warsh really got this nomination, I think people think, because he kept saying we want rates lower. Now he's in the actual position and job, and his term's going to outlast the current administration. So he's got to do whatever the right thing is. But he's a little bit, in a rock, between a rock and a hard place starting out. So we'll see by September. We're going to have a couple more inflation readings. We'll see what happens with the Iranian war. It does not look like it's going to wind down anytime soon, despite all these false starts. And that's actually going to be it's an interesting risk that, investors are not really focusing on. It just seems like, okay, the oil prices are not really feeding through in a big way. We have to stop this, but where is the exit? And we know with this current president, his tendency is always to double down, so this could become a factor, right, which it is not right now in the stock market, or in all the markets. So, but the implication for higher yields is not a good one for anybody holding debt. But I did want to mention on the tech side, because investors are very concerned about all the amount of debt that's going out. But a lot of the companies that are doing this have huge free cash flow. And even though it's temporary, and I say temporarily reduced, these companies are big cash flow generators, and that's not going away. so that when this investment period is over, even though it looks like a couple of years, and raising all this debt, the demand is insatiable. And when you look at some of the predictions out there, even, looking at the demand for high bandwidth memory chips, in the autonomous driving that's really picking up, in robotics, which is, already big, but going to grow much bigger, the demand, could increase fivefold or more. So you're going to have huge demand, and I think that, right now the concern is, okay, are they going to really monetize? And I think the market's just being too impatient.
Okay, well, I don't know. Do you own Meta shares?
I've owned Meta for years, and I always, new clients, new cash, I always add to it. I think the stock could stay under pressure here for a bit, just because of what Dan is saying. People were hoping the last quarterly call was also not clear, which also hurt the stock then. And people are trying to figure out, okay, where is all this extra going? And I think the problem is we're losing sight of what is going on in the underlying business. User growth is stronger there. It's 3.7 billion daily active users, 2 billion on Instagram alone, and engagement is increasing. It is working for them. Ads, advertising dollars are strong, and they have a history, except for the metaverse, of strong execution of making the investments. And this happened a couple of years ago when he was spending a lot on the metaverse, and the stock, people just said, I'm sick of this, and the stock got below briefly under $100. That was a huge buying opportunity. And so here, it may take a while to get clarity, but they have a history of executing very well. And as Dan mentioned, there's a number of things in the pipeline that they are doing, whether it's the subscriptions that they're packaging, which would be interesting. That will be, I think, incremental. You're going to have the agentic use. You've got, as Dan mentioned, the enterprise. They're just getting into that. So I think there's a lot to come here. And I think, if the stock continues to sell off for the next day or two, it's going to be a buying opportunity, because you mentioned that stock has been down every day in a row. But let's not forget the strength of their basic business.
Yeah,
Microsoft, I think the key to that story, why the stock is up 9%, pre-market, is really the AWS story. Yes, the Copilot and all that's very good. There were some good, very good metrics in this report. But AWS, the last quarter, was up 39, almost 40%. This time was expected, maybe the whisper number was 41. They came in at 43.
Oh, Azure, you mean?
Am I saying yes? Sorry.
AWS.
Azure. Yes, okay. I keep saying AWS. Sorry. Anyway, but thank you for the correction.
Yes.
Yeah, but Azure. And now their forward guidance is for 45%. And that's big, because it's also reinforcing that, cloud demand is strong. And so I think that's really what's, propelling the stock right here. And all the other stuff is important and it's good, but I think that's the key. And that will be the key going forward. And also Microsoft has lagged. It's still down year to date. And people sort of ignored it, and it got to a point where the risk reward was very attractive. I know I started, I've had it for a long time in my accounts, but I also started to add about a month ago. I said, look, whatever, low expectations there, more than incorporated in the stock. And then, fortunately, AWS, I keep saying that, Azure came in. So
it's also worth noting their remaining performance obligations beat expectations. Now, you don't necessarily want remaining performance obligations. That just means that, well, people are signing on, they want this, but you can't deliver on it because you just don't have the capacity. But nevertheless, it means that they still have a $678 billion worth of interest. Now, they said that would pay out over several years, but it's still worth noting that the expectations were for $647.6 billion. They came in at 668. So they are seeing continued long-term interest in what they have to offer.
Just one more quick point here, just to double down on this CapEx mention here, the fact that they are not spending as much this year, $175 billion. As you say, it's still a lot, but it answers the question of what happens if these companies don't spend as much as predicted. In this case, it's a good outcome. I also think it's so interesting that it's because they're extending the life of their equipment.
Yeah.
Right? Which is something that had also been one of the outstanding questions out there. How long is this stuff going to last before it starts to deteriorate? So
that's what 15. I forget. It was like 15-something years. They extended it.
They're going to extend it for 10 years. Another 10 years.
Data centers and
that
offices.
Helps. That brought down the total CapEx. So,
very interesting.
But basically, they kept it very controlled. And of course, we know that's what's been killing it. Killed Alphabet last week. Anybody upping their CapEx, and so this was sort of in addition, to the Azure. It was, relief that they weren't upping their CapEx.
Yeah, they got the memo. But we're seeing a rebound here this morning, and there does seem to be, in some of these names, and collectively, Qualcomm though is not participating in that.
Yeah. I'm
No,
sorry.
no, after
no,
you,
I was
after
just
you.
say Qualcomm, I think, is a one-off. I mean, that's just, I think they're trying to diversify their revenue stream because they're losing Apple. Apple used to be 25% of their total revenue, and then Apple has started to make their own, modems, internally, and by the end of this year, they should be zero. So they've known this for years, and
Right.
they're ramping
They've
up.
been
But I think
trying.
it's a problem.